Hello, everyone. Just slowly letting folks join. But welcome to today's session. Today, we are talking about taxes and tax prep. We are now in tax season. And so, so let's get started. So my name is Amagella, and I'm from the Innovation Cluster. And for those of you who aren't familiar with the cluster, we are a not-for-profit organization that supports startups working in innovation and technology. We do so by offering advisory services, access to partners, and workshops such as this one. We encourage you to apply if you have an innovative idea or a startup working in technology. And you can apply at our website at innovationcluster.ca. And again, welcome to Hands-On Tax Prep for Startups. In this session, you will gain an understanding of the various aspects of managing taxes for businesses. The workshop aims to provide entrepreneurs and startups with the necessary knowledge and tools to efficiently manage their tax-related affairs. And so today's workshop learning objectives are understand the different types of business structures and how to register for a business number, learn about income taxes, HST returns, payroll deductions, owner remuneration, and deductible expenses, gain insights on reporting grant income, SR and ED credits, US taxes and implications, and CRA issues, and develop strategies and techniques for effective tax preparation and management. So without further ado, I would like to welcome Kevin and Amy.
Perfect, thank you. Welcome everybody to our kind of presentation. We are going to let you guys kind of ask questions throughout if you just want to drop any questions in the chat. And then we will kind of try to answer those questions throughout the presentation. So first off, we're going to start with going over our topics for today, which were already a little bit covered here. Types of business structures, how to register for a business number, income taxes, HST returns, payroll deductions, different ways of kind of paying yourself, bookkeeping tips and tricks, deductible expenses, reporting grant income, the SR and ED credits, US tax implications, and any CRA issues. Now, a lot of this is going to be very brief, but if you have further questions, kind of as I mentioned, just don't hesitate to put it in the chat there. So first up here is the different types of business structures. So there's three main types of business structures that you can have. The first one is a sole proprietorship. The second is a partnership, and the next is a corporation. And I think further in here, I kind of talk about the different types and what those types of different businesses mean. So first of all, the sole proprietorship, for a business number, you don't actually need to have a business number under a sole proprietorship unless you have to register for an HST number or a payroll number. So the HST number is if you have more than $30,000 in sales in a year, then you do need to register for an HST number, which then registers you for a business number. Or if you have any employees and you need to do any payroll, you do need a business number to do the payroll. Under a partnership, you may need a business number as well, which is kind of the same as the sole proprietorship. It falls under if you need it for your HST or for payroll, then you do need a business number. And then a corporation, you do for sure need a business number. When you register for a corporation, CRA automatically issues you a business number, but from there you do need to register for different HST accounts and payroll accounts depending on what you need, but you are automatically issued a business number under. If you are a sole proprietorship or a partnership and you need to register for the business number, you can do so by phone, by calling CRA, or online through CRA's website. So these are kind of the main differences between your sole proprietorship, your partnership, and your corporation is the income tax and how they're treated. So under your sole proprietorship, all of your income is reported on your personal tax return, and it's all included in income in the year that it happens. It is due on June 15th of every year. So for this year, for your January 1st to December 31st of 2022 taxes, it is due on June 15th of 2023. However, if there is any balance owing, it has to be paid in full by April 30th to avoid any interest charges. Your next is a partnership return. So your partnership all the income flows into this partnership, and then it gets allocated out between the partners through a T5013. It is done based on a calendar year, and it's due by March 31st of every year. And then that partnership income will get included on your personal tax return, which is due by April 30th. For a corporation, so you have to file a corporate tax return, which is based on a fiscal year. So fiscal year end date is of your choice. If you need help determining what fiscal year makes the most sense, it is important to talk to an accountant to discuss that. Or you can choose one on your own, but I do strongly suggest talking to an accountant to decide that fiscal year end date. The T2, the corporate tax return, is due 6 months after the fiscal year end date. So if you've decided on a December 31st fiscal year end date, it is due by June 30th of the following year. So next is your HST returns. So you are required to register after you've hit $30,000 or more in sales in a year. If you have not hit that $30,000 in sales, then you have the option to register for an HST number, which just allows you to kind of recover your ITCs, but you do have to pay you have to charge HST on it as well. But you can voluntarily register if you're not at 30. There are 3 different types of filing frequencies for your HST returns. You can be monthly, quarterly, or annually. And each one of those has pros and cons. So if you are unsure about that, once again, I would suggest talking to an accountant about what the differences are on those and what would make most sense for your business. The next is your payroll deductions. So if you have any employees, what you need to know is that you need to withhold CPP, EI, and income taxes on their paychecks. Amounts that you withhold on those need to be remitted to CRA regularly. And CRA will set a frequency for you. The most common is a monthly remitter for payroll source deductions, but they can set you as bi-weekly or quarterly as well, depending on how much you have to remit. And as long as you make your payments on time, then sometimes they're a little bit more lenient and go to the quarterly filer as well. So for the most part, they are due, if you're a monthly remitter, they're due the 15th of the next month. So if you pay someone in March of 2023, the payment for the source deductions is due by April 15th of 2023. And that will change if you're a biweekly or quarterly, which I'm not going to touch on, but because it's not as common, but you can always talk to an accountant about that as well. So there's a couple different ways to do this, to do your payroll source deductions. The first one is to use a payroll provider. So there's many different types of payroll providers out there. There's people like you do it through QuickBooks Online. You can use ADP, Ceridian. They're just a couple of different providers that can do it for you. There are bookkeepers as well that will know how to do payroll and will be able to help you with that. If you want to do it yourself, there is also a CRA payroll deductions online calculator, which you go in and you enter the amounts and then it will spit out what you need to pay for source deductions.
Sorry, Amy, just in addition to that on the payroll stuff, just be aware that as the employer, you get the joy and privilege of also remitting payroll costs that your employees have had deducted off of their paycheck. For example, with CPP, if you deduct dollars off of your employee's paycheck, you as employer get the privilege of matching those remittances. So basically it's 100% tax to the corporation, the employer, of what the employee pays. For EI, which is employment insurance, you as employer get the privilege of paying 1.4 times what the employee has had deducted off their paycheck. Now there are maximums. Each employee maximum CPP is about $3,600 a year. EI is about $1,000 a year off of paychecks. So there are maximums on the employee's side of things, which means there is a maximum on the employer's side. But your remittances that you send to the wonderful souls at CRA is a combination of the employee deduction plus the employer contribution. You have to send both by the 15th of the month following the month of deduction.
Perfect. So the next part, everybody likes to talk about this, is how am I going to get paid? So there's a couple different ways to pay yourself, depending on the structure that you have set up. So if you're a sole proprietorship, I kind of touched on this a little bit before, but you're taxed on your net income on your personal return. So in theory, anything that's left over in that sole proprietorship is yours at the end of the day after you've paid tax on it. So that money is yours. You do with it what you need to do with it. As a partnership, it's taxed on your net income on your personal return as well. So with that T5013 slip, so the partnership does a return and then divvies it out to each partner. Each partner reports that on their personal returns, and that money is yours. So that's how you get paid through a partnership. The corporation is the one that you have a little bit of flexibility on. You can do either salary or dividends, which I always suggest talking to an accountant before making a decision, because it depends a lot on what the corporation looks like and what's going on in the corporation. The salary aspect is deductible in the corporation. So the corporation gets the expense there and then you get the salary. CPP is applicable. So you do have to pay into CPP as the owner, which also means your company needs to then match it as well. And then your other way is through dividends. So dividends is not tax deductible in the corporation. It's paid with the after-tax profits of the corporation. And then it goes to yourself and you pay tax on it again there. But there is no CPP cost on that. So dividends do cost a little bit less on a personal level, but then your corporation is paying tax on it as well. Anything you want to add there, Kevin?
On an integrated basis, it really doesn't matter how you get paid, via salary or via dividends. The ultimate, with the integrated tax system that Canada forces down our throats, the overall tax rate is effectively pretty darn close. I think it's about 1 or 2% more to pay dividends, but with dividends you don't pay CPP. And that's a significant cost every year. If you max out your salary at 60 grand or so, you're going to pay the maximum CPP, which is roughly $7,000 between you as employee and you as employer. So it's a $7,000 cost on a salary that you do not have on a dividend. Now, you can look at that $7,000 cost as an investment, because if you pay the $7,000 every year while you're working, when you retire at 65, you can get it at 60, you can wait till 70, but at 65 you apply for your CPP pension and the government's going to give you some money while you're in retirement. So does the $7,000 a year you're going to pay get offset by monies that you're going to earn in retirement from the Canada Pension Plan? And I haven't seen too many folks to come up with an answer on whether it's a good investment or not. I'd like to see those numbers.
Perfect. So next one is the bookkeeping tips and tricks. So our biggest thing is keep all receipts. So all receipts you should have, whether or not that is organizing it by month, organizing it by year, That's going to be kind of up to you and how you want to organize them, but make sure you have all your receipts in case CRA comes and asks you questions, audits you. You have all the documentation to support everything. Our next tip is to use some sort of software. So Dext is a software where you can actually take pictures of your receipts and it will automatically talk to some other software like QuickBooks Online, and it will post the transactions for you. That does get a little bit costly though. I do understand that most of you guys are just startups. So whether or not you keep all your receipts just manually sorted, you don't actually take pictures of them and upload them to something, you could get away with just using something like QuickBooks Online or QuickBooks Desktop, some sort of software that goes in and you enter all your transactions, everything that's been going on. Our next tip and trick is to use a separate bank account and credit card for all your business transactions. So keeping things separate is super important so that you're not mixing your business and your personal transactions. Although you can in a sole proprietorship, we don't recommend it just because it is harder to do the bookkeeping side of things. So we do recommend to always keep a separate bank account just for your business transactions and a separate credit card just for business as well. Within this software, you can also reconcile your bank statements monthly, which we do strongly recommend. So what that means is you're going in and you're taking your bank statement and you're using your software and you're ticking everything off that's on your bank statement and agreeing it to your software. So that just makes sure that every single transaction that's hit your bank account has been recorded in your software and that everything agrees. So you're not missing expenses, missing putting in income. You know that it's all there, which is also why it's super important to keep a separate bank account. If you don't have a separate bank account, then that can get a little messy and you'll be entering a lot more transactions than you probably need to.
Sorry, just one more comment. The reason we recommend all these tips and tricks, bookkeeping is critical for two reasons. One, it gives you the information about how your business is doing. You probably have an idea because if you've got money in the bank, your business is probably doing okay. If you got no money, you're probably not doing okay. But it also provides information on where the money is going, where the money is coming from, which is kind of important as the business owner to know how your business is doing, where the money's going, where the money is. But from our perspective, the most important reason you have to do your bookkeeping is for CRA. CRA is our tax authority in Canada called Canada Revenue Agency. And you are their victim. You are our client, but you are their victim. And if they select you as a victim, they're going to audit your business and they want to see all receipts to support numbers that you've given to them on your tax return, be it personally or be it corporately. If you don't have support for the numbers, you are now their most wanted victim. And you are going to likely pay a little more tax than what you should, because naturally, if CRA doesn't have support for numbers, they get to make up their own numbers based on their judgment, which of course is going to be in their favor. Now you are guilty. Now you must pay that tax unless you can prove yourself innocent via receipts. So it's critical to have your receipts. It's critical to compile the receipts into summaries with some bookkeeping software or manual spreadsheets or whatever. It doesn't matter, as long as you can find the support for that number should CRA come knocking on your door wondering where your numbers are coming from. That's why it's important to do this bookkeeping. You don't want to be doing it after the fact when they're already knocking at your door. That's not a fun scenario.
So we do have a couple of questions in the chat. So we have one that is asking that they are already incorporated federally. Should they still apply for GST, HST now or after they have reached 30,000, the 30,000?
That depends if you want to voluntarily register or not for your HST number. So if you do voluntarily register, you can actually get back all of the HST paid on your deductible expenses. So things like your cost of goods sold, you're paying HST on. So there is a benefit there. If you're not going to be collecting a ton of HST, you can actually recover back anything that you pay on it. But it is an administrative hassle that you need to make sure your bookkeeping is done, and you can actually file your HST return on time. So something like that is that's a con of it, but then the pro is you actually get to recover back your HST that you paid out on your purchases. So it's up to you if you voluntarily want to register or not.
I would say most businesses do want to register so they can recover the HST on costs that they've incurred.
Okay, awesome. And then another question. How much does an accountant charge for bookkeeping on average?
As much as we can. You can probably find a decent bookkeeper for 35 to 40 bucks an hour. You probably don't want us as accountants doing it because we're 65 or 70 bucks an hour. Bookkeeper is more than capable to summarize all the goodies and all the receipts into the categories that we need to do the tax returns. So using a bookkeeper, I would suggest versus the accountant.
Okay, awesome. Those are all the questions, so you can continue.
Thanks.
Okay. So next is going to be our deductible expenses. So sometimes business owners ask us, well, what is actually deductible from my business income? These are things that directly relate to the income that you're generating. So cost of goods sold, you can deduct any advertising, meals and entertainment when you're taking out clients, any insurance, business, vehicle, errors and omissions, office supplies, professional fees, rent, including some of your home office, salaries and wages, any travel and vehicle expense. Now, a vehicle log is required for your business use of your vehicle. And then phone and internet as well. So generally anything that that's a cost to you that you have to outlay in order to generate business income in the future is usually considered a deductible expense.
The list that we've provided is not an exhaustive list. There are many, many others. So if you've got questions, ask your bookkeeper, your accountant, your business buddies, whoever, whatever, that, should I be deducting this? As an example, golf. If you take a client out golfing, that would fall under meals and entertainment. But there's a specific clause in the Tax Act that says golf fees are not deductible for income tax purposes. That's just one silly example that's in the Tax Act. So if you've got questions about a specific expense, ask it, and then we'll try to make it deductible.
Perfect. So the next is reporting grant income. So I know a lot of startups do have a lot of grant income. So we wanted to make sure that we touched on this and let you know that it is taxable in the year it is recognized as revenue. So the year that you receive it and that it's revenue to you, it is a taxable source of income to you. And that is recorded either your personal return or your corporate tax return or your partnership return, however you've decided to structure your business. And depending on the agreement, HST may be applicable, but it really depends on what is in that agreement. So most often when you receive a grant, there is some grant paperwork that has to be signed. Make sure you read it and see what it says about HST. If you aren't sure, reach out to an accountant and ask those questions.
Guess this is my turn.
This is on Kevin for the shred.
SR&ED, scientific research and experimental design credits. So if you're doing research and trying to build a new wheel, to develop something, a new product, to overcome some hurdles in getting your product to market, those would likely be qualifying expenses for this credit. And not only is there qualifying wages, there's qualifying expenditures. And I believe the tax credit is 35% of your qualifying wages and expenditures. So it is most beneficial for you to talk to an SR&ED consultant on whether you would qualify. We were just talking to a client the other day, and they said they ran into a consultant that charges 15% of the money they recover on these R&D credits. It's a niche, it's a specialty. We can put this information on a tax return, and we have a general idea of whether it would qualify for these credits or not. But these consultants, when you submit your paperwork for these credits, there's two facets to it. You have to do the numbers crunching, which goes on the tax return. That's the easy part. You tell us the numbers, we stick them on the right schedule, you get your credit. But the more important part is the write-up of the projects and the hurdles that you're trying to overcome and what you're doing to try to overcome those hurdles. That's the critical component to the government, because they've got scientific advisors that will read your reports and decide whether it qualifies for these credits or not. And that's where these consultants come into play. They know the wording that needs to be put into these reports to make the government advisors allow your project to qualify for these R&D credits. Once you qualify, then it's game on. We want to make sure the qualifying expenses are as high as possible. Typically, the government does audit the numbers once, so you want to make sure you've got all your records. Typically, qualifying wages is your salary, and you're going to say, yeah, 50% of my time I spend working on R&D. Well, now you might have to support that 50%, and typically that's going to be a timesheet that from 8 to 12 on Tuesday, you spend time poring over journals and tinkering with whatever to try to get your product better or to overcome the hurdle. So you have to have some sort of support for that percentage to make sure the qualifying wages do qualify to get you these credits. They are most definitely in your favor, in your benefit to apply for these credits.
So we have another question in the chat, and they want to know if owners' wages can qualify for the deduction.
Absolutely. I think they put a max on it, if I'm not mistaken. So as an owner, if you pay yourself $500,000 a year, comfortable saying they put a maximum on what that is, on the amount you can deduct, and it will be audited. So the support for the number is your T4, but then you have to support the percentage of that T4 that is spent in R&D. But most definitely, owners' wages qualify for R&D credits. Yes.
Okay, awesome. And then we have another question that just popped into the chat. Founders of a company should report tax separately, one as employee and one as employer.
On payroll remittances, you do report. There is a reconciliation that has to be done on an annual basis if you have payroll. So you have to submit a T4 summary, and in there you do report separately the employer costs and the employee costs of payroll remittances. As a sole proprietorship, you do not do T4s, and there's no reconciliation that you have to do, but CRA does charge you CPP premiums on your personal tax return based on the net income of your sole proprietorship. And it's an automatic calculation. It's the 5.6% or whatever the number is, minus, so it's your net income minus 3,500 times the percent for that year, which I think is about 5.6, is the employee portion or the sole proprietor's portion. And then there's an automatic double up for the employer portion. And because you're a sole proprietorship, you are both employee and employer, so you get to pay twice. And that's an automatic cost that gets calculated on your personal tax return, in addition to the income taxes you might have to pay on your net income. And it's typically almost as much or more. It's a crazy high number for CPP. As an employer, sorry, as the owner, you do not pay EI premiums. We didn't mention that. So if you're a sole prop or a partnership, or if you're a corporation paying yourself a wage, you do not pay EI premiums. You as employee do not pay them. You as employer do not pay them on the owner's income.
Awesome. There are no more questions.
Thanks. U.S. taxes implications, Nexus and U.S. specialist. So, because we're Canadian accountants, we know the Canadian rules. U.S. rules, we know enough to get everybody into trouble. We know enough to try and keep you out of trouble. And the big thing for Canadian corporations that are operating in the States is this thing called Nexus. Nexus is basically, have you got a presence in the US of A? If you have a presence, hence Nexus, the IRS, which is the US arm of the tax collectors, the IRS wants to hear from you. So if you're a Canadian company and you have a sales guy that jumps in his car and crosses the border and drives into a few states and knocks on a few doors, does that mean you have a presence in the US? Does that mean you have to now file US tax returns? Because if you have a presence in the States, you now have to file US federal returns and US state returns, and in some cases, US municipal returns. So the US is massively complicated for their tax structure compared to Canada with the multi levels. And if it's possible to avoid having a US presence, you want to avoid it. But the simple example of a Canadian salesperson driving into the States, you probably have a presence in the States. Therefore, you should probably file all this US stuff. If you open an office in the US, you most definitely have Nexus. You most definitely will start filing US tax returns. And we're not going to do it for you because we don't know the rules. So our recommendation is to find a US specialist. We know of a gentleman here in Peterborough that has a lot of information and knowledge about US taxes. We would recommend using him. Or if you set up shop in whatever state, find an accountant in that state to do the US taxes. If there is a tax treaty between Canada and US, and Canada and most countries, that treaty is set up to avoid double taxation. So if you have a US presence, but it's owned by a Canadian company, Canada says you're going to pay tax on the profits you made in the States. You're going to pay tax on that in Canada. The US says, hey, you got a presence in the States. You better pay us tax down here as well. So it's double taxation. The treaty jumps in and says, where is head office, essentially, where is head office located? That's where you're going to pay the majority of your tax. So in our case, if you're a Canadian company with a US presence, you'll pay the US taxes. But then in Canada, you get a foreign tax credit for any taxes that you paid in the US. So there is an offset that you're not paying taxes in two countries on the same income, but it massively complicates your administrative process for filing tax returns. Yes, which means you're going to have a lot more cost. So if you're going to expand into other countries outside Canada, make sure you do it right, talk to the specialist, and go forward from there, knowing you're going to have a whole bunch of costs.
We have a question that has come in the chat. If we sell a product to a US company as a B2B, do we have a presence in the States?
No. If you are a Canadian company and you have inventory in a warehouse in Canada and a US customer says, send me one of those things, and you simply ship it to the States, that is not a US presence. Good question.
Perfect. So next we're going to briefly touch on a couple of CRA issues. So the first one we wanted to touch base on is non-compliance and arbitrary assessments. So this comes into play. So say your HST filing that you have now registered for an HST number, but you have failed to file an HST return for a certain period. What CRA can actually do is they can go in and do an arbitrary assessment, which then they basically just estimate what they think you're going to owe and say, pay us this amount. Now, those arbitrary assessments are meant to get you moving as a business owner to get that filing actually done. So once that arbitrary assessment is done, you calculate all the numbers and say, oh, this is actually truly what I owe. Your accountant or yourself or your bookkeeper will go in and actually file the HST return. The arbitrary assessment is reversed and it goes based on what is actually filed. The next thing is the capital asset additions. So very often capital asset additions are looked at. So say you go out and buy a new computer in the year, which is now a capital asset. It's not an immediate expense, but it is capital. It's going to last you more than 1 year. And if you add that to what they call this, this pool of assets, then what has happened, CRA will sometimes see that and say, hey, we need a copy of the invoice that proves that you purchased a new computer for this dollar value, and they'll take a look at it. Very often right now, we're seeing that happen on vehicle additions. So if you buy a new vehicle for the business, they are asking for that receipt, that invoice, the purchase agreement that basically says it is under the business name, and that the date is appropriate and the amount that is added into this capital asset addition is appropriate and is reflected on that invoice. Next one we're seeing right now quite a bit is vehicle expenses. So this is why it's super important to have a vehicle log of what you are driving for business purposes. So CRA, so if you say you have vehicle expenses of $2,000, you better have receipts and a vehicle log, something that backs up that vehicle expense. So CRA has been attacking that vehicle expense line. Same with professional fees. So if you have any professional fees, accounting fees, legal fees, anything like that, they are sometimes also auditing those amounts as well. So what it really boils down to is just keep good records. So kind of as we mentioned before, make sure that you have all your receipts and you keep them organized. So if CRA does ever come knocking on your door, you have a receipt to provide them to prove that it's right. And then now that's the end of our presentation. So we'll just kind of open it up to questions now, if there's any questions that haven't come in throughout the presentation.
Someone would like to know if you folks do bookkeeping now.
So we do bookkeeping. This kind of also boils down to what Kevin said, is that we are primarily an accounting firm. We do bookkeeping, but our rate for bookkeeping is going to be a little bit higher than someone that is that just strictly focuses on bookkeeping. So our fees are about $60 an hour right now to do bookkeeping. And as Kevin mentioned, you can probably find someone that focuses on bookkeeping for about $35 to $40 an hour.
We as accountants think we're too good to do bookkeeping, hence we charge that much more for it. We don't really want to do bookkeeping. Bookkeeping is absolutely critical to your business from a CRA perspective. So it needs to be done, but we don't want to do it. We want to focus on the tax planning issues for you as a business owner. How should your remuneration be structured, et cetera, et cetera. We don't want to focus on the nitty gritties. We want you to get a good bookkeeper that takes care of all the nitty gritties and crosses all the T's and dots all the I's and gives us a really good summary of what happened in your business during the year. And then we can take those numbers and worry about tax compliance and how best to minimize your tax and maximize your benefits from your business. That's our job.
Another question, is it required to give salary to the co-founders of federally incorporated startup companies if they are in Canada or overseas?
you are not required to pay the owner of a company. It is part of the remuneration strategy. If you've got SR and ED, well, you probably do want to pay a salary to the owner because some of that is probably deductible and an eligible expense for SR and ED as example. If you're paying salaries to somebody in Canada, there's zero issues. If you're paying salaries to an owner that is overseas, you probably got issues. The big issue would probably be withholding taxes. If somebody lives outside Canada but works on behalf of the company, but the Canadian company is sending them money, then Canada is not getting taxed on that salary of the individual that lives overseas. So Canada is going to withhold 15 or 25% tax, depending on what the tax treaty says with that company, with that country. And it's probably not beneficial. So you probably want to look at different structures.
Okay, and then someone asked, which incomes are exempt of tax?
Welcome to Canada. Essentially none. What's exempt of tax? If you have Indian status in Canada and you're working on reserve, then your income is tax exempt. That's one I can think of. That's about it. That's about it. CRA says, if you make money, give me some. That's the joy of Canada. Make money, pay money.
Okay, don't see any other questions in the chat. Oh, just another one came in. If we work with refugees, are they exempt from tax? Or someone in prison?
I'm going to say no, depending on their Canadian residential status. If you have residency in Canada, you pay tax as a resident of Canada on your worldwide income. So as soon as you have residency, not citizenship, but residency, and you earn money, Canada wants a piece of it. So if you're a refugee and you've got Canadian residency and you're making money, you're going to pay tax. Now, I understand, as a refugee, for example, you may get, for lack of a better term, I'll call it handouts from different charities and whatnot. That would not be income, but it's also not, it's not got nothing to do with business. So there could be some, call them handouts, that may not attract tax from charities and stuff. People with disability, there are special tax credits on their personal return. It's called the disability tax credit. And blind folks, that's they would fall under that umbrella as well. Disability in Canada is a very, very wide-ranging term. And on your individual tax return, you get an additional $9,000 tax credit, non-refundable tax credit. So there is some tax savings on earnings for disabled folks in Canada. Of course, there is a process to get that disability tax credit. You have to submit paperwork to the wonderful government. They then take 6 months to analyze it, and their doctors are going to say yes or no on whether you qualify for the disability tax credit.
And then for Ontario Corporation, do you have to file an Ontario tax return additional to T2?
So there is now a new Ontario return that does need to be filed directly through Service Ontario. So when you first set up your corporation, you'll get what they call a company key, which then allows you to go in and file this Ontario return. Now, the Ontario return is something you can do as a business owner, though. That's not something that the accountants do for you. It is basically, it goes in and makes sure that your address is still the same. When was the last time you kind of met? Are the directors still the same? It's all company information, not necessarily to do with financials.
The Ontario corporate return is integrated into the federal return. So there is an Ontario corporate tax return, corporate tax amount, but it's integrated into the federal tax return, which is the T2.
Okay, and then how does the co-founder of a startup company who is not taking any salary file a personal tax?
Most definitely. If you've got a corporation that's not paying you, definitely file your personal return with zero income on it. Then you'll be eligible for various tax credits that the government fires out to low income folks, such as a GST credit, the Ontario Trillium benefit, the Climate Action Incentive Program, you get more. There's a working income tax benefit if you've got low income. So most definitely, even if you have zero income, file a personal return. If you have low income, file a personal return. And from a government perspective, if you have high income, please file a tax return.
Awesome. And is there any range for your packages on offer for annual tax review?
Our pricing structure is all over the map. For a corporation that only needs a corporate tax return, you're probably going to be anywhere from $1,500 to $5,000 or $6,000, depending on how good your bookkeeping is. If you've got good corporate records, your banks are all reconciled, your expenses are all summarized, just to take your numbers, do a little bit of planning with you, put them on a corporate tax return, you may even get down to $1,000 a year. But if you don't do the bookkeeping and we have to do that for you, and then if you need what's called notice to reader, it's now called compilation financial statements, or if you need review engagement or audit financial statements for the bank or your financiers or whoever, you need a set of fancy financials, plus you need the corporate return, plus we have to do some bookkeeping. You're probably going to be $7,000 or $8,000 or $9,000 a year, depending on the complexity of your business. So it really depends on how much work you do. If you do a lot of work for us, saves us a lot of time, saves you a lot of money.
All right, so don't see any more questions. Oh, just another one coming. Of course, as soon as they say. So can we file personal tax returns on your own?
Absolutely, if you so dare. I would really strongly recommend with zero income, then absolutely you can do that yourself. I would probably still take it for the first time, I would probably still take it to somebody, because again, there are certain boxes. Most of them you have to do electronically. I wouldn't dare try to do a manual return anymore, even with zero income. I would probably try to do it in software, but I'd want somebody to look at it. And I've offered that service many times. Do up the return, bring your laptop in to see me, and I'll review it with you and make sure you tick all the right boxes so that you qualify for the various tax credits that you get. Because if you miss something, it's very seldom the government's going to come back to you and say, hey, by the way, you qualify for this credit, so we're going to give it to you anyways. Very, very seldom are they going to do that. You want to make sure you apply for absolutely everything you're entitled to, and then let them say, no, you don't qualify, or whatever the case may be. So I would say most definitely have somebody take a peek at it, especially for that first one. But yes, you can file it yourself if you so dare.
Awesome. I actually filed my own tax return yesterday, so.
Perfect. Somebody to review it.
My friend's an accountant, so I got him to
There you go.
check for me.
Perfect.
So, any other questions folks have? If folks want to inquire or chat with you or access your services, what's the best way for them to get in touch with you?
Send Amy an email.
Which my email's on our website. So if you go onto Inclusive Advisory's website, there is a staff directory in there, and you can find myself and Kevin under there. But Kevin is, for the most part, half retired. So your best bet is to probably email me.
Awesome. That's fantastic. If there aren't any other questions, then I think we're good for today. But again, thank you so much, Amy and Kevin, for joining us today and I learned a lot about taxes today as well, which is great. And so, yeah, like Amy said, you can check out their website. And yeah, feel free to keep in touch with the cluster as well if you have questions or anything really, yeah, just anything. So awesome. Thank you so much. And everyone have a
Thank
good
you.
rest of your day.
Thanks.
Thanks,
You
everyone.
too. Bye.
Thank you.
Bye.
Bye.
Bye, everyone.